You know, since the beginning of time, Wall Street has always been enamored with certain CEOs for a variety of reasons, right? Some business trailblazers like Thomas E. Watson Sr. or Alfred P. Sloan. Others like Jack Welch just simply made everybody a lot of money. You know, we began this week, remember, with the ultimate celebrity CEO of the moment, Warren Buffett, in that great letter. Again, I hope you read it. I ask you to read it. A reminder of good old-fashioned business practices. And yeah, he's made people a few bucks. These days, though, there's something different also is happening, right? A lot of people are becoming celebrity CEOs without achieving much. Think about this. Adam Neumann, he was the darling of Wall Street. He raised $22 billion for WeWorks. It's worth $800 million right now. That's the whole company. By the way, Newman's worth $1.1 billion. Seems like he got off pretty good. So here's the thing. How do you avoid falling for the charm? Joining me now, Wealth Enhancement Group Senior Vice President Nicole Webb, along with investor George Gammon. George, let me start with you. I mean, you know, I love your Twitter feed. You're sort of an all-around critic, but you're also someone who cuts straight to the chase. You know, we're in this area. I mean, it's celebrityism all around, right? It drives every single thing. That's how Kanye West can sell a gazillion shoes, right, and sneakers, even though he didn't play sports. What do you make of it, though, for investors? It seems like dangerous territory.
Yeah, I think you hit the nail on the head. And it just shows that the stock market is extremely overvalued because what we're prioritizing now is salesmen over businessmen. We're prioritizing narrative over fundamentals. And so when you're in that type of environment, you see the Adam Neumanns or the Mark Benioffs, et cetera, these celebrity CEOs, that's what shareholders favor. But at some point, that's going to meet economic and fundamental reality.
Yeah, speaking of which, Mark Benioff, loved on Wall Street, loved in the financial media. His reputation, though, beginning to take some blows. I mean, this is a company that is in the midst right now of laying off thousands of workers, but they're paying Matthew McConaughey $10 million to be the creative director in Pittsburgh. So Nicole, I want to ask you about this. You know, I think George made some fantastic points, but when you see stocks moving, when you see Wall Street give them a pass, oh, it's so-and-so, it was a bad quarter, they'll do better next time. How does a regular investor guard against that?
Listen closely, start to watch, pay attention. I think today is going to be really interesting as we watch him address 5 activist investors, all with the same underpinning, which is this company has incredible potential. We can see earnings growth, but we have to drive the bottom line, and we need to be a bit more of a steward of what's been built to this point. And to do that, we might have to move away from some of the entrenchment of the culture that's been created over the last decade. And I think that's very interesting. What I would say to investors who are trying to discern who we buy into, going back to what was just said, that it is about fundamentals. And in a market where we don't think we're going to have multiple expansion, but instead we go back to trading on earnings growth, the numbers matter, and we have to dig a bit deeper.
Let's talk about that real quick. You haven't been a fan of this market for a long time, but I feel like you're even more worried now than you were even months ago.
I am concerned about if the Fed holds steady, and I've never been one to say, let's fight the Fed. Let's assume that they're lying to us. It's just not the way that we manage on behalf of our clients. So if we listen to what the Fed has put out there, they are telling us that they are taking us to 2% inflation. And to do that, we have to destroy demand in the face of so much resilience in the labor market. And my concern, Charles, remains that if it is really managed to this target of 2%, given all the changes through the pandemic, where does that leave the valuations in the market?
But you're talking about breaking a lot of things, not just one thing. I mean, almost, I wouldn't say total destruction, but really, really a lot of carnage. On that note, George, you're an expert in the real estate area. We saw mortgage applications to purchase a home come in at a 28-year low. Housing affordability is the worst ever. You know, listen, I don't know how this younger generation will ever own a home. That's one area that seems to be broken already. Where do you think we go from here with the rest of the economy?
Well, with the rest of the economy, I think it's going to follow asset prices because we financialized the U.S. economy to such an extent that the real economy is going to follow wherever main strength S&P 500 or home equity prices goes in real terms. I think that's what's important, Charles, because if you look at a housing chart going all the way back to 1900 adjusted for inflation, you see that 2006 we had that big spike up, but now we're at even higher levels. also when you do a price to income type of ratio. And so just to keep up with the rate of inflation right now, housing prices need to go up in nominal terms by, call it 6.5%. And that's if you believe the headline CPI, which I don't think many of your viewers do, rightfully so. So let's just say 10 or 12 or 15%. If your house isn't going up at that rate annually, in real terms, it's actually decreasing in value. And I think that's what most people need to really get their head around.
Yeah, it's tough because that is an essential part of the American dream. Nicole, George, I love this conversation, but we're out of time. Hope we can do it again real soon, especially when Nicole feels better about this market. All right.